All right, today we're going to do a deep dive into a financial tool that, let's be honest, is often misunderstood, but can be incredibly powerful: whole life insurance. We're going to look at it not just as an insurance product, but really as a unique foundation for building guaranteed financial stability for your entire life. I mean, who isn't, right? In a world filled with market swings and economic unknowns, the idea of having a financial asset that's predictable, stable, and completely guaranteed, well, it can almost sound too good to be true. But that promise of certainty is exactly what we're here to unpack. So, here's our game plan. We'll start with the absolute basics, then we'll get into the mechanics, the really powerful advantages, and of course their trade-offs. Then we'll figure out who this is actually for, and wrap up by looking at the kind of impact this can have over a lifetime.
Okay, so let's jump right in with the fundamentals. What exactly is whole life insurance?
At its very core, whole life is a permanent contract. So unlike term insurance that eventually expires, this is built to last your entire life. It's really a combination of a guaranteed death benefit for your family and a built-in savings component, which we call cash value. And the best part? It's all funded by premiums that are locked in. They will never, ever increase. It's designed from the ground up to be the most stable and predictable form of life insurance you can find.
So how does the engine on this thing actually run? Well, it really all comes down to three core components that work together beautifully.
First up, you have the base premium. The easiest way to think about this is as the fuel for the whole system. It's that fixed payment you make that contractually funds everything: the death benefit guarantee, the insurance company's own reserves, and it kicks off the growth of your cash value. It's the engine that powers all the promises in the policy. Next up is the cash value. And honestly, this is where things get really interesting. This is a savings component inside your policy that is contractually guaranteed to grow every single year. You can think of it like your own personal savings vault that is completely shielded from market storms. It doesn't matter what the stock market does, this value is contractually forbidden from going down. And finally, we've got dividends. Now, while these aren't guaranteed, they are the supercharger for your policy's growth. See, if your policy is with a mutual insurance carrier, you're technically a part owner, and they might share the profits back with you. The most powerful way to use these dividends is to buy something called paid-up additions, or PUAs. A PUA is like a tiny, fully paid-up life insurance policy that you just tack on to your main one. Each PUA has its own cash value, its own death benefit, and it even earns its own dividends. This is what creates that powerful, compounding snowball effect that can seriously accelerate your policy's growth over time. So, we have these components. How do they build into these powerful, legally backed guarantees that make whole life so unique? We're not talking about hope or speculation here. We're talking about what the contract itself promises you. You know, the stability of whole life isn't an accident. It's the main feature. The guarantees for your cash value growth, your death benefit, and your premiums, they're all contractually protected. It doesn't matter if there's a recession, a market crash, or if interest rates go crazy. This is stability by design. The advantages here are just they're broad and they're powerful. You get predictability from day one, your coverage is guaranteed for life. The tax advantages are also a huge deal. Your cash value grows tax-deferred, you can access that money through tax-free policy loans, and when you pass away, your family gets the death benefit completely income tax-free. And hey, in many states, that cash value is even protected from creditors. Okay, this leads us to one of the most powerful and frankly coolest concepts: uninterrupted compounding. When you take a policy loan, you aren't actually pulling your money out. What you're doing is taking a loan from the insurance company and just using your cash value as collateral. This means your entire cash value balance keeps chugging along, earning its guaranteed interest and any potential dividends just as if you never touched it. Your money is literally working for you in two places at once. Okay, so nothing in finance is perfect. To get these incredibly powerful guarantees, there are some pretty significant commitments and trade-offs you have to make. So let's get into the reality check. The number one trade-off is crystal clear. You're swapping higher costs for higher guarantees. That promise of lifetime coverage, that permanent safety net, it's incredibly powerful. But funding those lifelong guarantees means the initial premiums are way higher than what you'd pay for temporary coverage like term insurance. You're basically paying a premium for absolute ironclad certainty.
And yeah, there are other important things to keep in mind. The cash value growth is designed to be slow in the early years because a lot of the policy costs are front-loaded. This is absolutely a long-term play. You have to be committed for at least a decade, probably even longer. And because it's all about stability, you are giving up the chance to get those huge upside spikes from the market. This is a tool for patient capital, not for speculation. So, given all those guarantees and those very real trade-offs, who is this actually for? I mean, who benefits the most from this unique financial tool?
One of its biggest strengths is just how versatile this asset is. Because the cash value is so liquid and easy to get to, a single policy can serve a whole range of financial goals over your lifetime. It could supplement your retirement, act as a capital source for your business, help you buy real estate, create a legacy for your family, or, just be your ultimate rock-solid emergency fund.
When we actually stack it up against the alternatives, you can see its unique spot in the world. Term life, for instance, has no cash value at all. On the other end of the spectrum, you have products like variable or indexed universal life, which have cash value but tie it to the market. That brings in risk and a lot of complexity. Whole life sits right in this sweet spot. It has strong cash value growth, but is completely insulated from the market, offering the strongest guarantees and the most predictability of the bunch.
So the ideal candidates are really people who value what whole life does best. We're talking about high-income earners looking for tax efficiency, business owners who need flexible capital they can count on, families who are focused on creating generational wealth, and really anyone who just wants to protect a chunk of their wealth from market risk and park it in a stable, predictable asset.
So let's wrap this up by zooming all the way out and looking at the incredible impact a well-designed policy can have over an entire lifetime. This is really where the long view pays off big time.
The true power of this thing is only unlocked over really long time horizons. That slow, steady growth you see in the early years, it eventually turns into an unstoppable compounding machine. The combination of that guaranteed interest rate, plus the dividends buying more paid-up additions, which then earn their own guarantees and dividends, it just becomes enormous over a few decades.
And for your family, for your heirs, the end result is often a massive immediate legacy. The death benefit is paid out completely income tax-free, which means for a lot of policyholders, it provides a seven-figure head start for the next generation, totally shielded from taxes.
So, here's what you should really take away from all this. Whole life gives you a permanent safety net. It's a predictable wealth base that's insulated from the market. It's a vehicle for uninterrupted, tax-efficient compounding. It offers multi-purpose liquidity you can use anytime, which makes it a really powerful foundation for any long-term financial plan.
And that really just leaves us with one final question for you to think about. In a world that is defined by volatility, is a contractually guaranteed, predictable, and stable asset the right foundation for your financial future? Well, only you can decide that. Thanks for joining us.